Welcome back to Inside Prediction Markets. We're going to start with the top 3 stories in prediction markets this week. And this week, we're going to do all 3 stories together because what we really saw was the same narrative appearing day after day with a slightly different name attached to it.
Which is kind of why we did the main segment.
Exactly. So, first of all, we have FanDuel announcing that they are market-making combinations on prediction markets. A day or two later, DraftKings announces that they have also been market-making combinations on prediction markets. And just today, latest numbers from Kalshi, over 30% of the volume is now in combos, primarily sports parlays. Chris, first thoughts hearing all of those stories?
Well, the first thoughts was the shark community going, "Oh, it's easy now." Like, but you ban your own players, but you're market making on them. That's so unfair and so
FanDuel and DraftKings
Yeah.
limiting sharps and then market making on a
And
platform.
it just
that
makes
doesn't
me
limit sharps.
laugh. It's like they're profit maximizing businesses. What do you want them to do? Like give money away to the shark community for no reason? I wish no sharp was allowed to play on novig. It would make my life a lot easier. Like I completely understand where they're coming from. They're just trying to make an extra dollar. They're abiding by their own rules and limiting their own customers, and they're trying to maximize when Kalshi does not have that. I assume they were just doing it on Kalshi. I mean, I don't know if they were doing it on crypto.com or
I would not be. They didn't specify either. Yeah. Well, I think some of them. We'll have to check back. The current prediction products they have sit on top of CME, both of them, but I don't know if CME offers combos. It's all kind of a big mess. We should have done more research.
Yeah.
One of the interesting points I saw people make, and I think there's some truth to this, probably not today, but it's like a long-term thing to consider, is if they're using the same or similar prices from their own sports books on these RFQ feeds, then they're going to struggle to win flow because everybody else can see those prices. Everybody else can copy trade them. If they differentiate, if they say, oh, well, I'm juicing it on my sports book, but there's actually a lot of room here, they're going to win a lot of flow, but then they're really being unfair to their sportsbook customers.
Why? I mean, why are they being unfair?
Well, on price, at least, they're being unfair.
Go to a different sportsbook if you're mad. I mean, I don't understand.
Well, but I think it's interesting because it kind of reveals how, platforms that allow for price discovery kind of naturally force fairness. And you could see a world where they can't help themselves but to offer better pricing on the PMs, and then slowly but surely customers learn that the better pricing is on PM. So it'll be interesting to see how that evolves. Now, what do you think? FanDuel, DraftKings, limit winners. DraftKings more than FanDuel, but both of them do it. Are they fundamentally capable of booking sharp flow and they just choose not to do it? Or is this a skill that they have never developed because they've never been tested?
So I saw the FanDuel founder, or the ex-founder rather,
Nigel Eccles.
Yeah, posted a great tweet about this, and it was like, "Look, candidly, limiting winners makes more money." And obviously, I don't blame them. Like if I ran a book, I would do the same thing. But I think FanDuel has a capability. They have 10% base limits to try to move off of sharp flow, and they try to incorporate some of this action.
They don't fully cut people as much as DraftKings does.
DraftKings is I don't think they have the capability of it. If they did, I would be quite shocked because it's just like there's a lot of things that they're making mistakes on that I don't know. Where FanDuel, I'm not seeing that. And
well, the question is it even hard to market make at all?
Oh, it's easy. No, I wish it was.
Yeah. Well, coming up next, that's more or less what we're going to talk about. What is market making? Why is market making difficult? It's just going to be the two of us today, but we're going to dig into everybody's favorite question. What is market making?
Yeah.
Stay tuned. No guests today, so we're just going to riff a little bit. I think maybe talk about some topics that have come up recently. And I'm going to start by putting you in the OptiGods hot seat to address a question that often comes up, which is, what exactly is market making anyway? What do people mean by this? So, Chris, what is market making?
That's a very complex question, and it's not going to be a simple answer. But I would say, to try to simplify it as much, market making is willingness to take both sides of a play if the edge is there, and that's true at the simplest form. So what I think confuses a lot of recreational bettors and traders and whatnot is they'll be like, okay, take the Jets and Patriots. Who do you like? Oh, I like the Jets. Well, a market maker say, well, I like the Jets at this price and I like the Patriots at that price. So there's like different variations of like market makers. And in the prediction market space, what I would say is I think there's 2 or 3 kind of main ones that I'm thinking of. One is like the true trying to be position agnostic, even flow on both sides market maker. They're going to trade extremely tight spreads, move off of flow. They don't have a real like, oh, this is sharp flow, this is like rec flow. Every dollar is treated the same. They are trying to be riskless as much as possible. It's not always possible in sports, but they try their absolute best. Their ROI is as close to zero as you can get with this, and a lot of their P&L likely comes in the rebates that are offered by exchanges, if there's any, or like the very tight margins that they get offering both sides. That'd be the baseline of a market maker. Another form would be maybe more of a positional taking or like directional market maker. They might, a good example I would give is if the market is pricing something at 50-50 or plus 100 or 50%, however you want to look at it, they might trade at 50-54. So their fair is 52, or they're buying at 50 and selling at 54. Well, they're going to get one-way flow. Like that is like based on the market, they're going to get one-way flow, and they have no problem holding big positions. They would take at 54, but like the market disagreed, so they're going to take it. Are they a market maker or are they taking a position? Who knows? And then the last is probably a combination of where like they might initially think it's 52 is the fair, and they trade off of that, but then they like adjust based on flow. They don't want to get too big on one-sided action, and that's kind of like the 3 levels of market makers that I think we see in prediction market space. And I would also say is, if you could think about it like practically, what they're really doing, what market makers really do to people, is they allow a user to buy and sell a contract or buy and sell a position as cheaply as possible, or as best price as possible right now. Like if you wanted to wait for someone to match you in the price, you might have to wait an hour or 2 hours, or maybe not even get it for your size. But a market maker will say, I'll take a little bit of profit and I'll do it right now, but it's also on them to hedge off. And they're kind of like, you can think of them as like grocery stores, kind of like they take low margins. They meet the customer and like the farmer for whatever, selling their product or whatnot.
They provide a service. Yeah. You talked about flow a lot. Can you explain what you mean by flow? What is flow?
Flow. That's what market makers are trying to capture.
Yeah.
Flow is just like trades coming in on one or both sides. So what a term you might say is, say the Lakers are playing the Grizzlies and LeBron has been out for 2 weeks and he's back today. We're going to probably see one-sided flow, which means one-sided trades or bets, however you want to think about it, if you're coming in all on the Lakers. And it might be a ton of recreational customers. It might be some sharp customers too, all trading on the Lakers to try to, and ranging from, literally a cent to potentially tens of thousands or hundreds of thousands of dollars. And that all that trades is considered flow. So if I say one-sided flow, that means you're getting it all on one side. If you say two-sided flow, that means you might have balance action. So like,
So if one side, in your example, it's the Lakers, is popular, we expect that the public's going to be on it. Doesn't that create pricing pressure that pulls market prices in that direction? Right? Like, is the equilibrium always a state where there is two-sided flow on these things?
Of course not. No. And
okay.
Well, I guess it depends on how you interpret it. Most of the time, I would argue no, because no one will like no recreational person wants to go against the Lakers. They're a very popular team. They want to. LeBron's coming back. He's going to do good. It's like, why would you bet against him or trade against him rather? And you might know like the fair price. You might have like sharps and other market makers might have models that know, okay, the fair price of this game should be 50-50. But if like they're also like these market makers are competing with each other to offer the best price to get that flow. If you could get that flow at 40, like if and I guess I take a step back here. Like the most of the flow coming in is going to come from recreationals who are going to be so price insensitive that they might need a price 15-20% lower than they were expecting before they actually were like, wait a second, this is a ripoff. Like I'm not getting it. So you're only competing with the market makers or other sharps, and there might be such a mismatch in flow here, or there might not be a mismatch in flow or opinions rather, that it doesn't. There's no downward pricing pressure. Like if enough sharps are willing to book or take the side of against the Lakers, they might stay at 48%. If they were gone, the recreationals would balance themselves at 30%. But there are some times where we see like a good example would be like the Floyd Mayweather versus Conor McGregor fight is a great example of that. There was so much public action that even though every single person with the brain knew that Floyd was the correct side, there was actually such a mismatch that it did put enough downward pricing pressure. But most of the time, that's not the case. I don't know if you disagree with this or not.
Well, so I think to summarize what you're saying is that if every sophisticated player kind of knows the fair value is here and the market participants are willing to buy down to a crazy price, what keeps prices from getting out of control is that there's no monopoly, there's no price coordination, right? Like the sellers are all competing, right? As long as they can capture more of this flow by penny jumping one another, they're gonna keep bringing prices back in line with like what's truly fair. I think what traditionally in sports books, the only way to actually create directional pressure to offset recreational pressure was if sportsbooks moved so far to punish the public that sharps would come in and bet the other side, right? So you had to have sharps cross the bid-ask spread, so to speak, to actually have an effect. And what's really cool about prediction markets is the effect kicks in a lot sooner, right? Because sometimes the bid-ask spread is really wide. Like the Mayweather fight probably was trading at like plus 500, minus 800, kind of at, and prediction markets weren't huge. Like Betfair would have been big in Europe. But in America, it was, there's a big difference between plus 500 and minus 800, right? And so maybe not a lot of room for sharps to come in and say, hey, you're cheating the public here and I'm going to put my whole bankroll up on it. So I think that's interesting. And if that thesis is true, that prediction markets, because they allow market makers to offer, are less likely to exploit the kind of public side, I think you'd probably see this year, especially with prediction markets exploding, certain markets, certain events where sports books and prediction markets are kind of ajar from one another, right? Where that screwing the public effect is much more pronounced on the sports books than it is on PMs. Can you think, I'm putting you on the spot, but can you think of any events that's happened with this year?
Oh, I mean, yeah, the most obvious one is the Joshua Paul fight.
Yeah.
Like I remember Hard Rock was offering Jake Paul at plus 400, Anthony Joshua minus 650. And you could get, like on Novig right now, it was trading at around minus 1,000.
Yeah.
An enormous arb, because Hard Rock is like only offered in a few states, primarily I think just in Florida, in person or whatever. And it's like that is 100% recreational flow. They're all gonna bet on Jake Paul, and then on an exchange where there's actually sophisticated, ball knowers. Like they're like, okay, well, I want to take it. And as you said, like they're penny jumping everyone to try to win all that flow.
Yeah.
But the only time where that it would be the same if it was so much recreational pressure that every single person with the brain got filled, then there's no more money. Like there's no more. The price needs to go down.
Yeah. I think you also in kind of smaller categories like touchdown scorer markets all throughout the season. You see it now. Part of that is a function of those not being two-sided necessarily everywhere. But yeah, like Super Bowl touchdown scorer props right up until post on PMs, like you were just seeing better odds than you can get at any sports book, and that's kind of a fun effect.
Yeah, and I think this is why we see, I think, top-down betting so successful in the current state is, this is a great example. If there's two-way action on a touchdown score, which I think most of the books actually do offer for most part, at least I know FanDuel does. So I'll give them credit there. They might be like, okay, Bijan Robinson, a hugely popular player, who's a recreational bettor that doesn't want to trade him to score a touchdown. But if they can just keep going lower and lower and lower because they ban all the sharps, so they can just rip off the customers. They can make it where it's like, okay, yes, Bijan to score a touchdown is minus 20% expected value. Bijan not to score a touchdown is plus 10% expected value. But they're not getting any flow on the no, because who wants to fade Bijan? But then at a place like Bookmaker, Pinnacle, or an exchange, if you make no 10% EV, those sharps will come and pound you. So you'll see, like, this is why you'll see, like, on the soft recreational sports books, you'll see that, like, oh, one side is a plus EV bet to a sharp sports book. Like, why is that? Like, why? It's because they're ripping off the customers, and the sharp sports book can't, just like the exchanges. They can't because the free market will push it back.
So market making, if you know what the fair is because you're a genius and you're charging more than fair on both sides and you're collecting from both sides, or if in the times you're asymmetrical, it's because you're punishing people. It sounds like it's free money and super easy to do. Is that right?
I wish it was super easy.
So why is it not easy?
The simple answer is you can't know the fair on everything. I mean, what's the fair of the Cavs Pistons game? Which will
Tomorrow?
Well, yeah, we're filming this.
Cavs down 2 going home.
Yeah,
it's Cavs all the way. What are they, like 62% to win right now? Something like that. Yeah,
something like that.
Yeah.
How are you deriving that fair?
Just eyeballs.
No, it's like you think, like, it's funny. Like I know sharps that bet the same sports or trade the same sports, and oftentimes they agree, but other times they disagree. Someone will be like, okay, Cavs is 62%. Others will be like, no, Cavs is 58%. Or someone will say, oh, wait, Cavs is 64%. Well, if you can't think of the fair and you get the fair wrong and you're trading a tight spread, you can get blown up and you can get a ton of one-way flow that's not recreational flow, that's sharp, toxic flow. So it's like every time if you make a fair 60% and you bid and you try to buy it at 58 and sell it at 62, and some sharp makes it 65 and goes in and buys all your 62, you could be screwed. And if they're right and you're wrong, they're going to be profitable and you're not. And if that continues to happen, you're going to be out of business.
What are the other vulnerabilities of market making besides just true difference of opinion on fair value with sharps? What are the other ways that it's really tough to do this?
Risk management is another big one. Like, okay, say, for example, an undisputed one. I'm going to buy the coin toss. I'm going to buy heads at 49%, tails at 49%. Okay, and I say, you know what? It's always going to be 50-50, unlimited action on both sides. Then I go to sleep and I wake up and I've got 10 million on tails and 1 million on heads. Well, I've got a $9 million position riding on whatever. I already forgot what I said. Whatever, tails or whatever. Well, you might not be rolled to take that big of position. So if you're not properly risk managed, you can go bust in a couple of trades.
Yeah. What about, like, unexpected injury announcements, things like that kind of are price shocks.
I'm gonna push back because I think that's just like I would consider that more price disagreements, or would you classify that differently?
I think it's one thing if, let's say you are taking true disagreement order flow and you have this choice of whether or not to update off of it. And then presumably, so for instance, let's say the whole market is sitting at, Cavs -4.5, and we have our lines at Cavs -4.5, and we take 3 back-to-back max clicks. We have the option to say, all right, let's go to Cavs -5, Cavs -5.5, or whatever corresponding pricing on the 4.5 line adds up there, and we will now be in disagreement with the market, and we will see arbitrage traders come in and take us the other way, right? And if we are right that those shockwave bets and trades meant something, then we've made a good decision. And if we're wrong, then we had already booked profitable trades and we made a mistake getting off of them, right? And we as market makers have the privilege of making decisions off of that. But if it's, click, click, click on Cavs, and then 2 minutes later, Cade Cunningham's out, and everybody moves to 7.5 and go, well, I didn't get to do anything about that. I just got screwed, right? Like, can we not unwind all that, right? Yeah. Which obviously you can't do. So to me, it's more like there's a cost to doing business associated with market making, right? Where it's just takers have this advantage that if they ever get something, they can pick you off.
Yeah,
you have
adverse selection, obviously. Huge.
Yeah. Right. You don't just you're not doing monumental volume all the time. You have spikes in volume when you screw up, and that gets priced into everything you do.
I would say market making would be easy, and you could probably run the whole thing if you could just like cancel like 2% of trades. Like it would be like the easiest thing
in advance, not after the fact, but yeah.
Like before the game starts. But like if before tip, you could say, I'm going to cancel these trades 2% of the time. You could run this whole operation by yourself and make billions of dollars. Like, it'd be easy.
And the classic quote unquote sharp sportsbook model was that you had counterparty information. And so you could really start profiling customers. So even, a Pinnacle or Chris who takes all comers, they could at least have some idea about who the user was and move more off one trade than another, which is not possible on prediction markets.
I would actually argue that sharp sportsbooks like Pinnacle and Chris are nearly identical to what a market maker faces, even with market makers not having counterparty information. And the reason I would argue that is, we all know this happened. Like, let's not pretend like it doesn't happen. Someone has a sharp Pinnacle account, they start clicking the wrong way on purpose to spoof the market.
Yeah.
And so it's like, if Pinnacle was like, say Chris Dierkes is a sharp and he has a Pinnacle account, he gets CLV all the time, let's just move off of him more aggressively. And then one day I start giving them wrong actions, and then Billy Bob, who's got another Pinnacle account, suddenly starts winning, fading those positions, giving you a world of hurt. So it's like, you can use customer and counterparty information, but if you use it too much, it comes back to bite you. Just as if you did have counterparty information as a market maker, sure, it'd be easier, but you could get screwed just as easily as them. And if you try to get reads on, at this time, this is a sharp move, like in a day, this is a fake out, they can always, like the sharps can always change their behavior.
Matt Metcalf, is a former director of Circa Sportsbook, currently with Mojo. We should have him on.
Yes, that's a good idea.
He's great. Super cool guy. He's talked about how, they would take a limit bet at Circa from a known, syndicate or, top player in some market. And they would look at it and say, this doesn't make sense. This is not his pattern of betting. I don't think this is real, and not move. And the customer would call up and say, what the hell are you guys doing? Like,
there's a contract here. I max bet, you move the line. Like that's how this is supposed to work. And it was exactly that. It was somebody trying to spoof the market. Maybe not spoof the market, but massage it into a particular place, which is legal in sports betting. You then get into the complications of that's not legal in prediction markets. What happens if you're doing it in those unregulated fields in order to update pricing in regulated fields? That's all complicated too. But yeah, so even then, it's like, as if you have customers, what are your customer expectations, and do you owe your customers anything? I mean, I think that's a pretty niche case specifically, but even just like, I think the question of, do I just have to show up with good limits on every single game every week to support this venue where I'm making all this money, right? Like if we have a slate of NFL games and Justin Herbert is a true 50-50 and nobody goes and quotes the Chargers game, it's like, well, how does that affect the customer?
Yeah.
And do we all is there some collective action problem where we just have to make sure that like the Chargers game is up? And that's a problem that I think the venues collaborating with market makers, people get up in arms a lot about a prediction market itself, like having a relationship with the market maker, but those are the kind of problems they're trying to solve, right? Is making sure that greed isn't winning out at every single step of the way. And then oftentimes I think what people find is what's the phrase? Be greedy where others are scared, right? Like
others are fearful.
Others are fearful. Right. It sounds a little more eloquent that way. If nobody wants to quote this Chargers game, then is it their huge advantage to be the only one doing it,
right? And
to be wide and have low limits that you're kind of flickering reloads on so that nobody can really crush you. But doing a valuation of markets like that, when you talk about flow, like really like understanding what is the flow going to look like on this? Is there enough volume of one kind that is worthwhile, and how do I balance all of my parameters so that when it's all said and done, like, I can eat the guys who get the news early. Like I'll still have made a profit by the time that happens. Right. That's the kind of, it's almost like meta trading, right? Like the individual trades are not very elegant when you're market making. They're the most boring things in the world. And then it's this kind of meta framework of like, why are the trades happening? That's a lot more interesting.
So would you say market makers are sharp?
No, I wouldn't.
Okay. Why not?
I think there's not a great shared working definition on sharp, but to me, sharp has always kind of indicated an ability to actually originate a price on something, right? And in particular, to recognize when the market is wrong and that there's surface area to attack. And being a market maker is almost more about like having a great working model of what a sharp is and how they think and understanding them.
I think the best example is the last guest we just had, Max. Definitely not a sharp.
No.
But killer market maker, like very elite at market making, but would not classify him as a sharp.
Yeah. I always think about like, this is really dumb, but Walter White and Gus Fring, right? Like you'd have to have this guy who understands the entire like crime and whatever and all this stuff, and then this one mad scientist who's like, the one thing I do is make meth, right? Like that's your originator, and like here's your market maker,
right?
Maybe not the most helpful metaphor, but
it
pops in my head. I want to pull up one tweet. All right, so this is from Adam Levitan, who's established the run fantasy football kind of guy,
a relatively sharp guy.
DFS, so really knows DFS, kind of the original peer-to-peer sports game.
I will say, just a shout out to him. I normally don't. I think all touts are frauds. He's the one person that I actually pay money for their fantasy football.
Oh yeah. It's fun to pay $50 for the ETR package for a league where the buy-in is like $100.
Yeah.
Like the ROI is not here, but I just have to take this seriously.
I know.
Okay, so Adam tweeted earlier this week, I love playing peer-to-peer games. In theory, betting sports on prediction markets is peer-to-peer. In reality, a lot of people market making at scale on prediction markets are among the best and most sophisticated sports bettors.
FanDuel and tons of other books are battling these market makers for your action. Hopefully no one actually thinks they're betting against Joe from the Deli. So what is your immediate reaction to this tweet from Adam?
He's pretty spot on. I mean, like, but what I would just push back on is, like, you could be trading from Joe. You could be trading from Joe from the Deli, but just with the market maker intermediary, where both of you guys are getting a slightly worse price, but you didn't have to wait to get that match. And the question is, like, if you want to wait and get the better price, sit there for 2 hours and massage the order book, make sure you're the top of the book, and et cetera, et cetera. If you want a price right now and pay 2 extra cents, market maker's there helping you out.
Yeah. I think that the one thing that gets lost in this a little bit is that a prediction market enables Joe from the Deli to dream big and try to become a killer, right?
Yeah.
Like you and I were both at one point the proverbial Joe from the Deli.
Yes, of course.
You know, like we weren't just born into this world being good at this.
Still aren't good at
it. Yeah. So other people think we are, and so we have to just suppose we are for the purpose of the conversation. And you know, it's almost like moving up in stakes at poker. Like if you're going from 1-2 to 2-5, like you're probably not going to win. At every level, most people lose, right? And the person who's just playing that level for the first time is extremely likely to lose. And oftentimes you move up and you get crushed and you have to come back down, or if you decide if this is really worth it. But that mechanism is what makes the journey possible, right? Like it couldn't be any other way. There's no other possible way to have a zero-sum game exist and be able to level up. And I think the sportsbook model, where they just kick you out, is like not a good alternative.
We've had many guests on that, like, Eggsy is only possible in this. And
yeah, Eggsy is Joe from the Deli. Yeah, like, again, shout out, but even he is like, I don't go to a great college, blah, blah, blah. I'm getting all these offers that are only because I figured out this prediction market thing. Like, it's changed his life.
And I don't mean to bash it, but Eggsy does not strike me as like this 180 IQ, like insane, like guy. But like, he's just like a hard worker. He grinded it out and found it. Like, could anyone do this? If I'm being honest, no, they couldn't. Probably 75 to 80% of people could not do it as he could do without a doubt. And the other 15 to 20% or 25% or whatever, maybe they couldn't, maybe they could, maybe they can't do it. But put the work in to it. But at least it's that opportunity there, which I think is a beautiful thing.
Yeah. All right. It's good to get a little conversation in today. Thanks for doing a solo with me. It was awesome. Oh, yeah. Like, comment, subscribe, 5 stars on whatever podcast app you use. Thanks.